السلام عليكم ورحمة الله وبركاته. This is a managerial accounting section for 4th year students, English section, all groups. Part Professor محمد مصطفى الجبالي, presented by ريهام محمد صفوت. Chapter 5 Relevant Information and Decision Making. First, I would explain some definitions. Differential costs. It is the difference in total costs between two alternatives. By mean I will compare two alternative only by cost. Differential revenue. It is the difference in total revenue between alternatives. The increase or decrease in revenue between two alternatives. Differential analysis. It is a decision process that compares the differential revenue and cost of alternatives. Here we would differentiate between revenue and costs between the two alternatives or more. Incremental costs. It is the additional cost or reduction in revenue generated by the proposed alternative in comparison with the current situation. Incremental cost includes additional cost or decrease in revenue by an alternative. Incremental benefits. It is additional revenue or reduction in costs generated by the proposed alternative in comparison with the current situation. That incremental benefit is the increase or revenue or decrease in cost resulted from a certain alternative. Outlay cost is the cost that requires a future cash distribution. And finally, opportunity cost for a resources that a company already owns is the maximum available benefit forgone by using such a resource for a particular purpose. That a company owns a certain asset. It could use that asset in two alternatives. The opportunity cost of using the asset in A alternative is the maximum benefit forgone by using that resource in B alternative. Managers often make a managerial decision whether to produce a product or service within the firm or to purchase it from an outside supplier. It is make or buy decision. Consider the following problem. Blue company makes industrial power drill where the production process has two steps that are A. Electric and mechanical components, B. Plastic housing. The following table shows the company cost information. The company produces and sells 100,000 units at $100 per unit. So sales equals 10 million. Variable cost including direct material, direct labor, variable overhead, and other variable costs. Okay, the total is 4,900,000, 700,000, 300,000, and 100,000 for the two processes. Sales commissions equal 10% of the total sales. Total sales 10 million by 10% equals 1 million. Total variable cost accordingly would be 7 million. Contribution margin will be calculated by deducting the 10 million sales minus 7 millions. Total variable cost equals 3 million. Total fixed cost 2,200,000 for the electric component and 480,000 for the plastic housing, equaling 2,700,000. The operating income would be 300,000. The first requirement, case 1, Blue Company has an offer to produce and sell additional 1,000 drill for 82,000 with the normal sales commission rate. Decide whether to accept or to reject the offer and the effect of accepting such offer on firm's operating income. Okay, first we would calculate the cost of producing the offer and compare the relevant cost of producing the offer with the sales revenue of that offer and decide whether to accept or to reject that offer. The cost in the previous table is related to producing 100,000 units. So we could divide the previous cost by 100 to get the cost of producing 1,000 drill. Okay, relevant cost includes direct material. Direct material in the previous table was 4,900,000. Dividing it by 100 equals 49,000. Direct labor was 700,000. Dividing it by 100 equals 7,000. And variable overhead was 300,000. Dividing it by 100 equals 3,000. And other variable costs equals 1,000. Sales commission is calculated by multiplying the sales revenue that is 82,000 by 10%, equaling 8,200, and accordingly the total variable cost is 68,200. Okay, the sales revenue from that offer is 82,000. So the contribution margin would increase by 30,800 from producing such an offer. So it is better to accept that offer, and the firm's operating income would increase by 13,800, and it would be 313,800. The second case, a supplier offers to provide 100,000 plastic housing for $12 each. What would be the effect on operating income if the firm made the plastic housing, assuming that the firm would avoid 350,000 of its fixed cost assigned to the plastic housing if it purchased the housing? Okay, it is a make or buy decision. The firm could purchase 100,000 plastic housing, rather making it on the firm. Here we should consider the incremental benefit of purchasing the housing and the incremental cost of that decision, and calculate the net incremental benefit. Okay. First, the incremental benefit of purchasing the housing would include reduction in variable cost. Total variable cost of plastic housing was 1 million. Okay, and the firm also would reduce or could avoid fixed cost of 350,000 by purchasing the housing from outside supplier. Okay, the incremental benefit would include reduction in variable cost and also avoidable or reduction in fixed cost by 350,000. The total incremental benefit would include 1,350,000. احنا قلنا incremental benefit is the increase in revenue or reduction in cost. أنا عندي هنا reduction in variable cost and avoidable fixed cost. Then the incremental costs include the purchase price of the plastic housing 12 per unit multiplied by 100,000 units equaling 1,200,000. Okay, the net incremental benefit would be 150,000. Accordingly, the purchasing of housing would increase firm's operating income by 150,000, that it is better to buy rather make the housing in the firm. The third case, suppose that the firm could purchase the housing for $13 each, where the firm use the vacated space for manufacturing a deluxe version of its drill, assuming that it could make 20,000 deluxe units and sell them for $130 each, in addition to the regular 100,000 units. Variable cost per unit of the deluxe units is $90 each. Sales commission 2% and no increase in its fixed cost as the firm uses the capacity of housing in producing the deluxe version. What's the effect of purchasing the housing and producing the deluxe version on firm's operating income? Okay, in this case we have two situations. First, the firm would purchase the plastic housing from an outside supplier $13 for each, and it will use the capacity of producing the plastic housing inside the firm in producing additional product that is deluxe unit. It would produce 20,000 deluxe units and sell them for 130 each. The variable cost would be 90 per unit, and the sales commission 10% of the total sales revenue. In this case, we would first calculate the incremental benefit of that decision and the incremental cost. Incremental benefit is the increase in revenue or decrease in cost. Incremental cost is the increase of cost or decrease in revenue. First, selling or producing and selling to 23,000 unit deluxe by 130 each unit would generate revenue of 2,600,000. The variable cost related to producing the deluxe unit is 90 per each. 90 multiplied by 20,000 units would equal $1,800,000. Sales commission is 10% multiplied by the total sales revenue, that is 2,600,000 equaling 260,000. So the contribution margin is the difference between the sales revenue and the total cost would equal 540,000. Incremental cost of that decision would be the firm would purchase 120 housing, plastic housing, 100 for the normal product and additional 20 for the deluxe product. Okay, 120 rather than 100,000. The unit price is 13. 120 by 13 equals 1,560,000. making the 100 unit of plastic housing at home was the total variable cost was 1 million. ارجعوا للتيبل بتاعة الأرقام الأساسية بتاعة المسألة الأساسية. the total variable cost column B, the total variable cost of plastic housing was 1 million. يبقى أنا بقارن بين حاجتين، إن أنا بعمل البلاستيك housing in the firm variable cost was 1 million. purchasing the 100,000 units from outside supplier at 13 plus purchasing 20,000 units for the deluxe at 13 would equal 1,560,000. الفرق بينهم هيبقى 560,000. اوكي، يبقى انا عندي التوتال incremental cost 560,000. total incremental benefit 540,000. okay, incremental cost here is more than the incremental benefit by $20,000. accordingly the operating income would decrease by $20,000 by accepting such a decision. The operating income would be 300,000 minus 20,000, so it would be 280,000. so it is better to refuse that decision. Best luck, and in the coming section we would consider more problems related to make or buy decision, incremental analysis and opportunity cost.